On July 29th, 2020, the gold market did something it had never done before. In a single trading day, 89.36 million ounces changed hands across London's bullion market, the largest daily volume ever recorded since the LBMA started publishing that data. The next week, on August 6th, gold printed an intraday record above $2,075 an ounce, a level it had never touched in the history of the metal. Now here's the part that matters. Retail traders watching that chart saw a parabolic move and a number that felt impossibly high, and most of them either chased the top or froze. Smart money saw something else entirely. They saw where all that volume was sitting and they used it. Same chart, same candles, two completely opposite outcomes. The difference wasn't a secret indicator. The difference was that one side understood liquidity and the other side didn't even know it was there. That's what this video is about. Why gold, more than any market you'll ever trade, respects liquidity, and how you can start reading it the way the desks do. Here's what we're covering. I'll explain what liquidity actually means when a professional says it, why gold is structurally different from the market you probably learned on, how price gets pulled toward pools of resting orders, what a real setup looks like on the chart, and where retail keeps getting it wrong. Not financial advice, just education. Let's get into it. Let's start with the word itself, because liquidity gets thrown around until it means nothing. When a professional talks about liquidity, they're not talking about how easy it is to buy or sell. They're talking about resting orders, the stop losses and pending orders sitting at obvious levels on the chart, waiting to be triggered. Think of it like water behind a dam. Every time price makes an obvious high or an obvious low, a pool of orders builds up just beyond it. Stops from traders who are long sit below the lows. Stops from traders who are short sit above the highs. That water has to go somewhere, and price tends to move towards it before it moves away. Why does this matter more in gold than almost anywhere else? Because of scale. In 2025, gold traded an average of around $361 billion per day, and during stress weeks in early 2026, that figure spiked toward $965 billion in a single day, the highest on record. That is an enormous deep market, and the players moving real size in it, banks, funds, central banks, cannot just click buy and fill a massive position at one price. If they tried, they'd move the market against themselves before they finished. So they have to fill where the orders already are. They have to go to the water. That structural reality is why gold respects liquidity so cleanly. The big participants are effectively forced to seek out those pools, and that leaves a footprint you can learn to see. So what does that footprint look like? Let me walk you through what this looks like in practice. Picture gold grinding sideways in a range for a few sessions. There's an obvious high up top that price has tapped 2 or 3 times. Everybody can see it. Every breakout trader in the world has a buy stop just above it, and every trader who's short has their protective stop in the same place. Underneath the range, there's an obvious low doing the same thing in reverse. Now, both of those levels are pools. The high is a pool of buy orders. The low is a pool of sell orders. Price will very often drive up through that obvious high, trigger every one of those stops and breakout entries, spike for a moment, and then reverse hard and fall back into the range. The breakout traders who just got filled are now trapped, watching price move against them. Here's the retail interpretation of that exact move. Retail sees price break the high and thinks the range is over, we're going up, I'm in. They buy the breakout. When price snaps back, they get stopped out and they call it a fake out or manipulation and move on angry. Retail asks, where is price breaking out? Smart money asks a completely different question. Smart money asks, where are the orders that price needs to fill before it can actually move? They watched that same obvious high and understood it wasn't a breakout level, it was a liquidity pool. So while retail was buying the spike, smart money was doing the opposite, using the flood of breakout buying to fill their own sell orders at a better price, then riding the reversal back down. Same candle, one side is trapped, the other side is positioned. Why does gold reward this behavior more reliably than, say, a random small cap stock or a thin altcoin? Because those markets don't have the depth or the participation to enforce it. A thin market can gap, get halted, or get dragged around by a single order. Gold is too big and too watched for that. When gold reaches for liquidity, it's not one player being cute. It's the natural consequence of enormous size needing to fill against resting orders in the deepest commodity market on earth. The behavior is baked into the structure. That's the whole reason I keep coming back to gold when I teach this concept. It shows you the mechanism in its clearest form, like reading a fingerprint that hasn't been smudged. So how do you actually use this instead of just admiring it? Start by marking the obvious levels, and I mean obvious, the high everyone can see, the low everyone can see, the equal highs where price stalled twice at almost the exact same price, which is a screaming sign of stops stacked in one spot. Those equal highs and equal lows are the clearest liquidity pools you'll find because they're so clean that half the market has placed orders in the identical place. Then instead of trading the break of those levels, you wait. You let price go, take that liquidity. You watch for the reach beyond the level and the rejection back. The setup isn't the breakout. The setup is what happens after the pool gets swept and price refuses to continue. That rejection is your signal that the real move is starting in the other direction. Now, I need to be straight with you because this is where a lot of channels would oversell it. This is not a machine that prints money. Price sweeping a level and reversing is a tendency, not a law. Sometimes gold breaks an obvious high and just keeps going because the break was real and there was genuine momentum behind it. If you sold every sweep blindly, you would get run over. That's why you always trade this with a stop, placed beyond the point that would prove your read wrong. If price reclaims and holds above the level you thought was a sweep, you're wrong and you take the small loss and move on. There's no version of this where you skip the stop.
A couple more honest warnings. Don't overmark your chart. When you first learn to see liquidity, the temptation is to draw 20 levels until the whole screen is covered in lines and every move looks like it's hunting something. That's noise and it'll paralyze you. 2 or 3 genuinely obvious pools per time frame is plenty. If you have to squint to justify a level, it isn't one. And on days when gold is chopping with no clear structure, no clean pools, no obvious highs or lows, do nothing. There is no rule that says you have to trade today. Some of the best decisions in this game are the trades you don't take. An empty corridor with no doors isn't a setup. It's just a place to wait. Here's the shift I want to leave you with. Stop thinking about the chart as a set of patterns to memorize and start thinking about it as a record of decisions. Every level on your screen exists because human beings and algorithms placed orders there for reasons. A liquidity pool isn't a shape, it's a crowd of traders who all made the same choice in the same spot, and that crowd is exactly what larger players are hunting. Once you see gold this way, the candles stop being random. You're not reading a picture anymore. You're reading behavior, where people committed, where they're trapped, and where the money has to go to get filled. That's the level the professionals operate on, and it's available to you the moment you change the question you're asking. So here's my question for the comments, and I actually want to know, what's the cleanest liquidity sweep you've ever seen on gold? The one where price reached above an obvious high or below an obvious low, swept the stops, and reversed so hard you knew exactly what happened. Drop the level and the time frame. I read these. If this helped you see gold a little differently, hit subscribe because that's how the channel grows, and it's all I ask. I'll see you in the next one. Stay disciplined.